Hello, and thank you for tuning in to the Art of SBA Lending podcast. Today, we are switching it up again, and we are having a roundtable discussion on the future of SBA lending, because these last few years have really changed things, and we'll get into it more in the episode, but I want to take a look back at where we've been, where we are today, and where we're going. And so I have invited a few very distinguished guests. I have Javier Jorge from Lake Michigan Credit Union, Kevin Rafferty from Paradise Bank, and Lynne Singletary from 44 Business Capital. And I invited them all down to Art of SBA Studio headquarters for a discussion. And the discussion was long and it was very interesting. But because it was a little long, we're going to break it up into two parts. So this week, we have part one of that conversation, and then come back next week for part two. So without further ado, let's get on with the show.
So I've been in lending for 12 years, and you guys know I'm all about speed. So I'm going to give all you BDOs out there a pro tip. One of the biggest cogs in the process is getting the borrower to send you the underwriting package. And the last items that they send are always the business plan and projections, because it's the most time intensive. So they save it for last. But that delays the process. The small business owners I know, they don't want to sit in front of their computer all day. They want to go run their business. And so that's why I send them to Rapid Business Plans right out of the gate. They make it easy for entrepreneurs to tell their story in a format bankers love. They can help with the business plan, projections, and assumptions, and turn it around in as little as 4 business days. Just yesterday, I had an ITL deal come across my desk, and I sent them straight to Rapid Business Plans because that export business plan is essential to my 90% guarantee, and I want to make sure it's done right. And guess what? The cost can count towards their equity injection because I'm going to build it into the project. It's a no-brainer. Now, I have one last tip. If you don't do startups, well, now you do. Feasibility studies tell you if the borrower's business idea is going to work. And in my experience, can give the bank the added comfort needed to get to a yes. And Rapid Business Plans offers these as well. So go to rapidbusinessplans.com and set up a Get Acquainted call. I'll leave a link in the show notes below. All right, guys. Well, thank you for joining the Art of SBA's panel on the future of SBA lending. I just want to go around and have everyone introduce themselves. Kevin, since it's your first time on the podcast, why don't you go first?
Kevin Rafferty, Paradise Bank.
All right, so Kevin is probably like one of the godfathers of SBA down here in South Florida. He's been doing, why don't you just give a little bio on yourself?
Well, I've been in the SBA industry too long. Started a SBA program, Paradise Bank, 13 years ago, and last year we were made the top 100 with a small department, so we're kind of lean and efficient.
It was very impressive. All right. Thank you, Kevin. Lynne, it's been a while. You are our second ever guest on the podcast. Why don't you give everyone a brief background on yourself?
Sure. Lynne Singletary. I'm with 44 Business Capital. We are a division of Berkshire Bank. I have been in SBA lending for now 29 years, so
Woo!
quite a ways. Seen a lot of changes. I'll be good in talking about the history of SBA lending. But, yeah, I mean, I've known Kevin for a long time. We've been in the industry together.
And Javier, a recurring guest on the podcast now. Why don't you give a brief background?
Well, thank you for having me again. I'm surprised that you keep inviting me. I am the SBA director for Lake Michigan Credit Union. I do not have the length of career as these two amazing co-panelists, but I think I've done a couple things, right? So lifted a couple shops from the ground floor, and now very excited about a larger footprint with the credit union.
Very nice. The reason we got us all together is because I feel like the last couple of years especially, things have been changing at a much more rapid pace than previously, and maybe COVID and, shutting it down and going remote and stuff like that has played a part in that. But I thought it'd be a good time to just kind of pause and take a look back at where we've been, where we are now, and then where we think we are headed, and just have that conversation. So let's start with going back. So like if you look at SBA lending 10 years ago versus today, what's different? I know we're working from home more, people are more remote. It's obviously technology has advanced, but Kevin, like for you who's been doing this for a while, like what stands out that's different now versus 10 years ago?
Well, I'll even take a longer time horizon. Way back in the day, SBA was a little mysterious. We have the benefit of a lot of progressive administrators who really got the SBA up to speed. But back then, it was old school knowledge. It was GP lending. It was dealing with the districts. Through the private sector, starting with Gene Hewitt, I think, Diane Seaborn, Susan, got a lot of people from banks who really kind of got SBA a little more avant-garde. We'll see that in the new SOP. But for me, it was the way we did business, more GP, district, balance sheet, RMA, pro forma balance sheet lending.
Mm-hmm.
Has it gotten more efficient?
Yes, definitely more efficient. I mean, as Kevin was saying, when I first got into this industry, there was one or maybe two PLP lenders in the whole state of Florida.
Correct.
Otherwise, you had the North and the South District, which we still have, but you had to package your loans up. You know, we didn't have the internet and all that, so you had to package your loan up and send it to the SBA district office, where they would do, just like GP, they would do an analysis of every single loan that you were processing, because you weren't PLP, and they would screen it out. They would send you they would get it approved or not, and then they would send you the authorization, and that's the way we had to process all of our loans until, and I can't remember what year it was or in what time frame, but SBA came, or I think it was Congress came and said, you know, you were going to have to scale SBA offices down. So then they moved to the centralized processing, which is then why many lenders started getting PLP, were awarded PLP. Now almost every lender is PLP at the moment. But so that streamlined the process greatly when they did that. And that was probably when you were talking about bringing in the bankers, and, you know, the mindset of let's make this a little less time consuming, because it took a long time to get an SBA loan done.
So at that point, a lot more lenders came in, and then did it start getting like more competitive in that sense?
Absolutely. So I have the numbers here from 2000 to 2019. I'm sorry, 2000 to 2009, SBA 7A authorizations were about 123 billion, and then from, what's the next time frame? Come on. Here we go. From 2010 to 2019, it went up to 205 billion. And then so far from 2020 to now, it's about 93 billion. So we're on track for about, 400 billion by the end of probably 2030. So that's pretty impressive. That's quite a jump. And I think it's because more and more lenders and banks have gotten into lending. When I first started, the major lenders were the non-bank lenders in SBA. Very few of the larger banks were I don't even know that they could spell SBA, much less even think about doing them. And then I remember I was with the money store, and First Union bought the money store. And that was like a big thing. It was like, wow, this, big national bank is buying this little SBA group. And then it just kind of snowballed from then.
Huh.
If I can add on, Lynn, to the late 90s, the top 4 lenders in order: the money store, Heller Financial, AT&T, which morphed into CIT, and then GE Capital.
All non-bank.
Then you had Amresco, and I think SBLC were like number 9 and 11. They dominated. There was a little bit of ignorance of SBA with the lending community, but also with the public. So the loans were smaller, the cycle time was longer, and there was this knowledge base that was very controlled, and it wasn't out there. So over time, that's really morphed. And I give a lot of credit for the banks that got into the SBA who helped morph that.
And I think that's what's made SBA so popular now. I mean, business owners didn't even know about what was available through the SBA financing, and now it's many of the banks are offering it, and many of the banks have SBA lending groups, and it's just exploded.
I mean, that's interesting. So if you go back, let's just say 10 years ago or so, 15, whatever, if you had that conversation with a small business owner about SBA, let's say to buy a business, what was that conversation like? Did they already have an idea of what this was, or was it foreign to them?
See, I think SBA lending really helped the business acquisition community, the business brokers, because people couldn't get loans to buy businesses when there was so much goodwill, lack of collateral. Through SBA lending, it really opened up that industry.
Yeah, like when you were in like the money store days, and when you were you were probably at Heller at that point.
Heller Financial.
So, were you telling the market what SBA lending was, or did they already know what it was?
No, I think we were telling them. I mean, we were educating them on what could be financed through SBA. I think the internet too. I mean, the internet, people now can just Google. If you're a business owner and you've been turned down by a bank, or you can't get the financing that you want. I mean, there's a lot of people just go on the internet and say, Google SBA financing and look at all the information that comes up about SBA lending now on the internet. So back then we didn't have that. You didn't have the internet.
And the loans were much smaller as well
They
with the
were.
price of real estate. For many years, we dealt with a $2 million cap.
Oh yeah. Yes, exactly. That was huge when they increased that to $5 million. That really was huge for SBA 7A.
Like most of you, I use outside counsel to close my SBA loans. And when you bring in outside counsel, they become a critical part of the process. So you can't just bring in a firm that dabbles in SBA. You need a firm that focuses in it. Lewis Kappas is one of those firms. Lewis Kappas is a nationwide specialty law firm with decades of SBA experience that can help lenders navigate SBA compliance in the modern landscape. Look, SBA lending is complex and riddled with gray area. You need counsel that can provide clear advice so that you, as the lender, can make an informed decision. You can't just send every deal GP. But compliance is just the baseline. Communication and customer service is also critical, and that's where Lewis Kappas shines. Their SBA team is experienced, professional, and understands not only the legal side, but that these are real-life transactions for real people. So check them out, follow them on LinkedIn, Lewis Kappas, or go to lewiskappas.com. So how's it changed for you guys as people working in the industry? Because if you now can be that much more efficient with your time, you were probably working full-time, 50, 60 hours a week. Now you guys probably, I assume, working 20?
Not quite. Just driving less.
Well, what do you do to fill that time now? Just doing more production?
Well, you're doing more, outreach on the phone, on the internet, you're still doing the networking that you do, and it's interesting because when I start to have a slow period, going back to the basics of picking up the phone, calling your referral sources, calling people, going on the internet, doing some research on what businesses are being sold, who's selling them, that kind of thing. I just go back to that, and then you start making your calls and marketing. So it's less. I find a lot less driving and a lot more phone time.
Well, yeah.
If I may jump in here, because I've been just soaking in all the historical, context, but I think it's about scale, Ray. I mean, now to your point, right? The knowledge of SBA nationally has really skyrocketed, and I think PPP 2020 really, took that exponentially to another level. And I feel I'm more of a catcher. Right, just receiving in multiple forms of communication and interactions with potential borrowers across a multi-channel footprint. Now we have social media, we have all the organizations that we work very closely with, and it's just it's a lot more, right? Because at the end of the day, although we've seen a significant growth in the number of SBA participants, let's just be frank, it's a drop in the bucket when you look at total loan originations from a C&I perspective nationally. And SBA, we know, has significant advantages over traditional lending in some aspects, right? Mm-hmm. And that education, I think, has been our main driver and job as advocates, as participants in this program. I feel like we're all technically competitors, right? But this is a community that focuses on supporting our small businesses in our communities. And the reality is, if Kevin funds a small business that then does business with someone that Lynne funded, right? That's a net positive gain for everybody. And frankly, it's, I think, one of the best kept secrets that we don't want to keep a secret. And our job has been to really, push that out there. And now with the landscape that we have today, it's a lot more dynamic. It's a lot more active, but it's exciting. I mean, I'm a general optimist. I think most people would say, but more people that find out about this program, it's a net positive for all, win-win-win for the entire community.
Well, it's out there. I mean, with now it became a household name during COVID with PPP. And when that happened, we all went remote, although I know, some banks did not stay remote for very long. But overwhelmingly, it seems like, these shops are more and more remote driven. And that's like something we talk about it, but there's some real positives and real negatives to that I don't feel like we've really flushed out quite yet.
So I know from a labor perspective, and if you are an SBA shop and you don't offer remote as an option, you're going to have a smaller worker pool to select from.
Sure.
And it's a very competitive labor pool because, as we have already mentioned, there's a significant amount of new entrants into the space, new shops coming in, and they all require people. As much as we want to talk about technology enhancements, this program is people-driven at the end of the day, and that intimate knowledge of the program, because it's not black and white. We all know this. The SOP is predominantly gray. We know where the box is, but every day I come across something that I just don't have a specific answer, and you have to bounce off your counterparts or your expertises in other venues like our trade association or the actual SBA directly, but those are human interactions, right? So going back to needing people, I've been a remote worker predominantly my entire career. It's been very beneficial for me, and that I think is where the industry is going towards. I mean, everyone would love to have the entire team in one spot, especially if we're talking about the back office staff, right? Underwriters and closers, portfolio management. But the reality is the people that really know their stuff, they're spread out. And, you're going to have to either balance between, building your own people internally and then organically kind of like everyone did in the past, or setting up a work environment where a digital online framework works, right? So remote work comes with other requirements. You're talking about you're going to need very robust systems where you have VPN access, document sharing access, chatting across the teams framework. And you can get there to drive efficiencies, but to your point, Ray, we do lose some of that interaction from the face-to-face, right? Those organic conversations, those thought-provoking conversations about what works, what doesn't work, that creativity. One of my favorite things is to work with my lenders on deal structure, right? This is the opportunity, these are the requirements and the needs that the borrower has. What is the best structure to meet those needs, right? And it's not just that particular request, but planning out the next, short-term, medium-term, long-term capital access needs for that borrower. It's kind of hard to do that over chat, to be frank.
Mm-hmm. Our industry has grown over time, but the training level of the training lenders has not kept up with it, and there's just a dearth of talent out there. So SBA is a little different than any other industry. If you're a manufacturer, you hire locally, the law firms, the locally. In the SBA, we're going to go where the talent takes us.
It's a specialized lending. It's very
Right.
specialized, and there aren't that many underwriters and closers out there that know it.
So you'd rather have a trained person out of market than to take the time to train somebody in market just to leave them for a higher salary. to my earlier conversation, we talked about the 4 big lenders, Money Store, where you came from, Heller, where originally I came from, GE Capital, and CIT. They were big trees, and all these managers went out and formed their own banks. And from those trees formed many branches. Thereafter, we haven't seen it. Oddly enough, Live Oak is now the King Kong of SBA.
Right.
And you see where Emory is aligned, and we're starting to see that. But thereafter, we're blessed to have Shatterbox help with the talent pool. And shout out to Dustin for that.
Yeah, yeah, that's true. But yeah, I mean, the underwriters and the processors are scattered all over the country, and I mean, our bank is a perfect example of it. We've got them all over the place, and you know, it works.
Okay, let me take a couple polls here. Who is in a fully remote workplace? Who's
the whole division or
division,
individually?
Division.
The whole division.
Yeah.
I mean, we're flex.
You're hybrid.
Yeah.
So you have an office. Some people are there. Some people are out.
We are a community bank. We are community bank based. Everybody comes and works. PPP, no PPP.
So in person.
You have the ability to work from home, but it's usually on nights and the weekends. So, but we're a little different. We haven't scaled to the national level. We're trying to cover the state. We're trying to cover the more, expand our footprint, and that'll be our next conversation.
Well, Kevin, you have trained from scratch multiple people who are actually some of the brightest people I've met. I'll say Maria is very good. She's very smart, and she came to you with zero SBA knowledge. And you worked with her in person at the office to get her to that level, and you continue to help her grow, and she's doing amazingly. But my worry is what you're talking about is all these SBA underwriters and closers that are spread all over. Are they transferring their knowledge? Like in 10 years, will there be any left? Isn't that a big problem in our industry?
Huge.
Yeah, it is. Same as originators. You know, if you look at the, you guys are one of the younger ones in the group, but if you when you go to Flagel and you look around, there's not a ton of younger originators, business development officers out there. A lot of us will be retiring at some point. So yeah, it is. I think that's a good point, Ray. Very good point.
Nagel looks like 50 Shades of Grey.
You know, it's funny. It's a bigger trend across the entire finance industry, right? I mean, if you ask at the regulatory meetings, what their biggest concerns are is succession planning. And the talent that's going to be shifting, from the boomer generation retiring, right? What talent is going to come into their shoes? And SBA is only exacerbated that further, right? Because that's we already talked about the labor shortages in general, and in that labor pool that is currently working, I would say would be in that older category, right? Mm-hmm. But I'm a little more open-minded in the fact that I think, 10 years from now, I don't know if we're going to have the same level of personnel requirements. Because I do envision a potential future where if you look at other industries, right, the banking in general is a laggard, right? We're not the first movers. We're not the first adopters in technology, right? We're risk-averse, right? Let everyone else do it. You're looking at the stuff that other companies are doing now, and it could be argued that you're leveraging these new technology sets are allowing us to be significantly more productive, and therefore take out more value on a per of FTE basis, right? Great example in a somewhat related industry field, finance, right? CPA bookkeepers. Historically speaking, have been on average, a really good CPA bookkeeper could do 50 companies on a monthly basis, right? So more than that, you're really stretching it, and probably that's a lot, right? Well, with the new AI and connections with API through the financial institutions and AI interlay, the job has now been from the little manual journal entry perspectives and some of that just manual labor components has been automated. And that same bookkeeper now can do 250 companies. So you're talking about 5x productivity gain. And we're talking, that's a white collar, high knowledge, very specific financials, everyday kind of conversation. And that CPA now is focused on the nuance, the hard questions, not the repetitive action. So how is that going to translate into our industry? I wouldn't know for certain, but the trend is going to be that we're going to be able to handle more and focus on the complex and leave the simple or the mundane to automated systems.
Okay, this is where I want to go, because I've heard people say you can't automate my job because of, we know what we're doing. And like, you're coming at it from a standpoint of almost like you can automate to get to 5x in that standpoint. And so part of our job as working with clients is almost like it's consultative. It's sometimes just talking to them. That's a big part of it. There's definitely some stuff you can automate. But that's the question. Like, do we really think we can automate, we can apply automation to our job to get us 5 times more productive in our industry? Because I know we say no, like in our industry, like there's no way. But like, let's really think about it. Do we envision a world where that can be possible?
Well, I think already our job, or my job at least, has changed over time because of technology. And because right now, I mean, when I first started, without the technology that we have now, if I was going to go and speak to a potential borrower, I'd get in the car and I would drive across town and speak to that person, or drive to a different city and to be able to have an appointment with that person. Now I can sit in my office and Zoom that person and not have to spend the hour or 2 hours driving here or there. So in that way, my job has changed. And so you're making a good point, is how much can I be replaced by an AI type of
like as
scenario?
It sits today, like what parts of your job right now do you think AI could take over for you?
Well, I think you still need the human touch. There's business owners who want the consultation. They want the feedback and talk about their needs and what they need. So that's a good question.
There's 2 different aspects. Through technology, AI, and through the new SOP, the processes are going to be more efficient. The throughput will be faster. Mm-hmm. But we are in the risk business, and that's where it comes down to the humans. Mm-hmm. I recall 20 years ago, give or take, Fair Isaac had a credit score, and they thought they could do loans under $1 million with the Fair Isaac score. It didn't work out for many banks who've done it. Look at other lending functions. We have mortgages, auto loans. You can desktop underwrite auto loans. If somebody's working, they have good credit, you can figure out they could pay a $700 a month to get them to work and back payments.
Highly predictive.
But if it's a $15,000 a month, they're not paying that from their personal cash flow. You need to underwrite the business. Some businesses, it's hard to identify risk, and that's where the knowledge base comes. And that's where I think the talent will.
So
it's a good point, because the credit scoring system is, can work well, but then again, it can throw out a lot of good loans that should be approved, but because it's not fitting right in that box, it gets declined. So that is a good point. You need the human touch to understand the business and what's going on.
So that human judgment, I think it's there's a great example. I think AI, everyone talked about, beating the grandmaster in chess. Remember that?
Yep.
That happened a while back. So they have these annual chess competitions between the grandmasters and AI. They introduced a third category, which was human plus AI. And recently, the human plus AI combination beats the AI alone and the human alone. Mm-hmm. So that human judgment, the creativity, that understanding, correct, Kevin. I don't believe the algorithms have the systemic a solution for approving loans. But I think that there is a good chunk of your day as far as aggregating the information that you need in order to make the judgment call. That piece can be automated to a significant degree. Envision a future where instead of you having to sit through the financials and analyze them, the information is presented to you in the format that you prefer. Almost kind of, same way that a committee does today for a credit approval, but instead of having an underwriter put it together, a system extracts the information either through an API directly through their accounting software or their CPA, or off the documents themselves through OCR, optical character recognition. That information can be presented to you instantaneously, and then you, understanding your expertise, your geography, your market, can provide your value judgment, your intuition that you've accumulated over the decades of experience. And that credit decisioning will still be a human component, but all the steps before that and all the steps after that, documentation, closing, monitoring, can all be done real time and instantaneously via digital channels. So that's the future. Where when I'm talking about scaling, so you focus your day is more on that relational component, right? How do you build relationships at scale?
Yeah, we talked about leveraging technology to get the throughput quicker. Once we've accumulated the loan package, the longest lead time is preparing roughly a 20-page credit presentation. Through OCR, which you mentioned, you could see the fluctuations in the balance sheet and the P&L, and you can create that through AI. But I tell my analysts that you are an analyst, not a novelist. So therefore, for the human capital,
Right.
is to edit it, identify the risk. But it would help the throughput tremendously.
Yeah.
Well, it sounds like your job is safe, but the underwriters and closers are at risk. Because you're obviously very bullish on technology, and it's sounding like turn our industry on its head, really. 'Cause that's so far from and I mean, some of the people here at the table might be doing it actually in even more efficient ways than some of the other banks doing it. Because there's about 1,500 SBA lenders, in terms of an institution that's made at least one 7A loan in the last, in this fiscal year. So 1,500. The bottom half of that roughly probably is doing it in the most antiquated way possible. They're far away from even what I'm doing today, let's say. But for what you're saying is, I think it makes sense for the small loans because you can score them. I think it makes sense maybe for a working capital, a debt refi, certain types of loans like that. I feel like you have to take the transactions out of that in a way. Still, obviously, room for efficiencies, but I'm just thinking business acquisitions, like that is something that just takes somebody kind of that really understands it. And maybe I'm wrong. You tell me. But and then you're working it every single day to get information from a seller and a buyer, and trying to see if the seller or if the buyer can replace the seller and how that's going to work. And then collecting the documentation from all the different parties involved, because it's not just the business, it's a seller, it's different third parties involved. And I just don't see how, other than simply AI taking numbers, extracting them, putting them into my spreads and maybe the narrative, I can understand that, but I don't see how you can end up making that process any more efficient than it is today. And it's not the most efficient process today. Do you think the transactions are different?
So in the future that I would like to be in, right, there will be a premium for the companies that have organized information, right, and verified and organized, right? So how much do you appreciate that business owner that has all their information ready to go out the gate? I mean, that's impressive. Mm-hmm. Imagine that information already in a digital format that just is received instantly into your whatever your underwriting platform or a consumption credit memo format is. I'm not arguing that the personal judgment, human element is going to be removed, my argument is that that's going to be the main focus of our jobs from this point forward in this world, right? Because we do McKinsey level analysis in all of these businesses, right? And one of the things, Kevin, and it still frustrates me, it's like, why don't we share this information with the borrowers, right? Tell them the good, the bad, and the ugly, right? You look really good here. This is challenging. This is your number. Here are your benchmarks against your peers. I mean, that's very valuable outside of the access to capital, but we don't share that information because of fear of lender liability, right? I mean, because
I with the right borrowers, I certainly share.
Okay.
Sure,
You know,
absolutely.
you give them a copy of your credit memo.
No,
No, as the consultants, as you go in and you're looking at their financials, and if you see, okay, well, their cost of goods sold is way off compared to their competitors or the people in their industry, same as payroll. Sure, you'd sit there and go, why? I see that it's off. What's going on with your cost of goods sold, or what's going on with your payroll? Tell me, And usually, they're pretty impressed that you're like, oh, wow, okay, yeah, you could tell that from the numbers there. But yeah, that's what you would do to, if you can't do a loan, if for some reason you can't do a loan because of what you're seeing in the financials, then you got to explain it to them and say, next year when this looks better,
it's not
let's
a no.
talk about it.
It's a not now.
Yeah, let's just talk about it next time. Or, after your accountant fixes these things that you say are wrong in there, then, let's
And that's
talk
the
about
piece that I don't think it's ever going to be automated, right? People need, especially in small business, they need that relationship to really extract the value of the financing, right? Because just having access to capital doesn't guarantee anything, right? But applying the monies in the right ways, monitoring the business, and tracking where we deviated, why, and how to course correct, that's hugely valuable. And I don't know about you, but in my career, my biggest clients today are the ones that I gave $100,000, $200,000 to 7-8 years ago, and they're all maxed out, right? The good ones, not every one of them, but it's interesting where you see you remove the transactional approach, you look at a customer lifetime value approach, and you start small and you just keep in your mind your seeds for your larger portfolio activity. I think at LMCU, more than half of our originations is that follow-up loan over time, right? And the way that we continue that relationship component, old school and new school, right, is, okay, what are your plans? I want to know where you want to be next year, 5 years from now. If you're going to do that, this is where you're going to need to be, right? You're going to want to have a minimum, EBITDA of this if you want to be able to have access to that, right. And give them targets. It's very, very surprising, and frankly, it's almost like my little cheat code, because the people who listen end up being lower credit risk, because at the end of the day, that they're applying, and you're not taking a big $3 million risk on someone that you don't have a relationship with, because you said, hey, I told them your COGS were too high. You need to look at, finding better suppliers, right? And they do it, and then all of a sudden that drops to the bottom line, and then all of a sudden you have better debt service coverage. It's a win-win-win for all parties involved.
Well, Kevin, here's a question for you. So you've been with Paradise for, you said 13 years, right? So have you seen SBA borrowers that have come in as strictly an SBA getting a 7A for a loan, and then they've progressed through the bank, now they're conventional, they're just ready for the conventional
graduate
lending?
They sure have, and Javier makes a great point about graduating relationships, and I'm glad we're more focused on the bigger picture. Mm-hmm. It's the value proposition of being at a shop long term has the comeback effect. Right. The average tenure, according to one BDO recruiting shop years ago, was 2.6 years. I don't think it's different today. Yeah. So it's hard to have the customer relationships come through if they can't find you. Mm-hmm. There is a value proposition, staying long term, graduating customers, taking to the next level, following up, be relationship. We have the Hunter-Skinner methodology. It's catch and release, right. Staying with the borrower, collecting the payment. There's definitely some value proposition on that.
I mean, that all sounds great, but there's a lot of people that are at more production type shops that I just don't see them sitting there doing these types of value add type of things, like after an approval or after a loan closing, like sitting down with them and talking about their COGS. I don't know, maybe it's just me, but I just think like we're on to the next deal at some of these places. And we get the commitment letter, they sign it, they read half of it. We're racing towards closing. You close, now you're running a business, and you're not taking the time to stop and think about, you know, switching suppliers to reduce COGS, even though it's a great idea. Like, am I wrong there?
Well, wait, if you're in a production shop, you're tasked with production. So you're looking at new deals. You're looking to figure out new brokers, new relationships. Don't forget the existing customers. They're part of your chain. How you doing? You know, just on a personal level. Ray, how you doing? How's business? And you get referrals, and you should care. And you know, caring about your customers helps you and helps you be a better life.
It just seems like it's always about speed, and like people, when they reach out to me, hey, I have a deal, when can we close? That's like literally the second question. Maybe I'm just in a different world, but like they're not asking for, you know, my financial advice. I'll give it to them when I feel like I need to, but it just seems like everyone just, all they want is to close and to close yesterday.
I'm in the same boat because I am in more of a production and have been basically my whole career in SBA lending has just been more in a production, a loan origination production shop versus the total relationship. Now, what I found, though, in the last couple of years, I have had more prior borrowers who have come back to me to buy another daycare or buy another restaurant, or you know, so there have been repeat borrowers because I've stayed in touch. Because maybe when I was going through the original process, we were able to sit down and talk about, you know, some sort of something going on the balance sheet or the income statement, or if they were buying a business, kind of helping them sort of walk through those numbers. So that kind of thing was more of a relationship driven, but that's why I asked you the question. I don't have the ability to move someone from an SBA loan to more of a conventional, because we're a national lender only on the SBA side.
I think that has, well, it's a competitive marketplace, right? And everyone has their value proposition that they provide to their potential borrowers. And, you know, I think it's more of indicative of there's way more demand than there are supply of SBA. I know it may not seem that way sometimes when we're out there trying to drum up business, but the reality is, I think to your point earlier, talking about the number of active SBA lenders, I think the top 20% to 80% of all volume, right?
Something
It's that
like that.
80-20 rule, right? So the people that can get it done, you know, that's massive value, significantly. So that's the bar, right? So if you can't get it done, you're not going to get any traction. So in Ray and the shops that are transactional, they get it done, right? So if you want certainty, that's great. But then there's the additional value proposition, relationship building, and that mindset is a long-term perspective, right? Because we don't know if the market becomes saturated with SBA lenders and a lot of people get it done, then how are you going to compete? What's the next value prop that you're going to have for differentiation? You don't have that problem now, and it may not arise, but the additional benefits from my perspective in my career, the way I've been taught, that relational approach is a lower risk, higher reward. You know, there's frankly not a lot of conversation about pricing. There is a lot of easier conversations about risk reduction and mitigations, and that, you know, it ends up being a more profitable, but not maybe at scale, right? So we're not pulling up Live Oak numbers, right? But the numbers that we are pulling up are very good as far as margin contribution across the board. And that's because we built that relationship with those borrowers. I mean, only time will tell, Ray. I mean, it's difficult to do that, right, at high volume, because you're gonna how many borrowers are you dealing with on a monthly basis? Dozens.
I mean,
I
I
would imagine.
get like 3 people call me every day.
That's so you don't have there's not enough hours in a day to be able to provide that value proposition to that level of clientele demand, right? But maybe in the future, if everything that it comes with developing those relationships ancillary, like doing the research, putting together the information, that's a lot of time. And we're talking about high salaried individuals that are doing that. So it's not cost productive. But if that gets reduced, I mean, I think my bet would be the shops that focus on that in the long run will have a competitive advantage in the long run.
Well, your point on going to market and the value proposition is a good one, and it's one that we will discuss on part 2 of the Future of SBA Lending Roundtable.
All right, that's it for this week. Don't forget to subscribe to the podcast so you never miss an episode of the Art of SBA Lending. And if you have any feedback or suggestions, email me at ray@artofsba.com. Until next time, ta-ta.